and then I'll share the screen. All right. So essentially what I'm hoping to do with this presentation is give you some highlights on chapter 2. And if you want to see the highlights from chapter 1, go and find the link to the video under content on the grades site. So what I do with these is, first of all, I'm recapping the previous week. This was probably the most important slide that's included in my presentation from last week. And it's animated in last week's video, but here what you can essentially see is that 2 of the 3 goals that apply to any business are economic or financial. So in an accounting or finance course, we're concentrating on helping to understand how the business can survive from one day to the next, because by doing so, that business will at least have the opportunity to succeed. If it doesn't survive and fails, we never get a chance to access the possible rewards for owners, all right? And both of these goals, the achievement of them is dependent usually on the business enterprise acquiring some resources. Those resources typically consist of people and money. Where do they come from? They come from key stakeholders. And in finance and accounting, we typically focus on those stakeholders who are providing large amounts of capital, like investors and lenders, okay? If you look at week 1, you'll see there's a slide that identifies 9 different groups of stakeholders, but we're concentrating mostly on 2. So these stakeholders, in order to provide what the business needs in terms of people and money, they do so in exchange for something coming back to them, which is usually some form of money or social benefits, okay? And what's important to people who are engaged in business and the use of financial information to make this decision about whether to inject money is the process that they go through, which typically depends on some criteria. And I've identified 5 primary business performance criteria that these key stakeholders all use with different emphasis. Like the lenders emphasize, for example, cash flow, liquidity, solvency. The investors emphasize growth, profitability, and cash flow, okay? But the investors will also look at liquidity and solvency because they can impact these other things in the future. So all the stakeholders look at all of these, but some emphasize different ones. And what this diagram intends to show is that these stakeholders can get information to help them assess these criteria by pulling it from the financial statements. So if they want to assess growth and profits, they can get information from the income statement. If they want to assess cash flow, they're going to get it from the cash flow statement. If they want to assess financial condition, things like liquidity and solvency, they're going to get that information from the statement of financial position, also called the balance sheet, okay? And this diagram organizes the financial statements under these 2 goals. So the statement of financial position helps these key stakeholders assess financial position, which is key to achieving goal number 2, surviving from day to day. You understand? Okay. These financial statements, the statement of income, statement of cash flow, they are used by the key stakeholders to help assess financial performance. And through performing financially, lenders get repaid out of cash flow. Investors make money as a result of the company growing and becoming profitable. You understand? So that's how all these concepts hang together and why we put such emphasis on understanding the decisions that key stakeholders have to make. And as a result, they want the information that's in financial statements. So this course focuses on, well, what information is in the financial statements? But this is a reason why it's important and to whom. So in these presentations, I make 2 lists. I make a checklist of what the course faculty thinks you must know to be able to pass the assessments. All right. In chapter 2, that includes what are the financial statements. And I've kind of just described that in the first slide. You're also responsible to know what the financial statement elements are. That's the 5 that they identify: assets, liabilities, equities, revenues, and expenses. And you need to be able to define them and identify their characteristics. For example, the key thing that distinguishes an asset from any other financial statement element is what?
Oh, its ability to generate money in the future.
Probable future economic benefit. That's the key thing that makes an asset an asset. If it doesn't have that ability, it can't be an asset. And if it's a cost to the entity, it's more likely an expense. Now, the significance of that is if it's an asset, it ends up on one financial statement, the balance sheet. If it's an expense, it ends up on a different one, the income statement. If it's on the income statement, it reduces your equity. If it's on the balance sheet, it doesn't.
Yep.
And one of the things that business owners are interested in is increasing their equity. So they have a tendency to want costs to be assets as opposed to expenses.
Mm-hmm.
But if it doesn't have that probable future economic benefit, it can't meet the definition of an asset, and therefore it's more likely going to be an expense on the income statement.
Yep.
The third thing Chapter 2 requires you to know is the interrelationship of the financial statement elements through their inclusion in these accounting equations, the basic one and the expanded one. And I'll show you in a moment an enhanced slide corresponding to that first image that will demonstrate how these relationships are, how these elements are connected. Okay. The fourth thing is we start to get you exposed to transaction analysis and processing, and what transactions are, which is an exchange between two parties where each party gives something and gets something in return. And we want you to be able to analyze the transaction. In other words, the two parts, what you receive, what you give. And those two parts are both accounted for in any business entity's accounting system. And that's what makes up the double entry system, okay? It's what keeps the accounting equation in balance. We have to put something on the left side and something on the right side. Now, the second list I make up in these presentations is what I recommend my students learn just for a deeper understanding so they can develop insights and be much more comfortable with how this information is used. So what I've identified in Chapter 2 is transactions in terms of the exchanges that impact financial position and frequently financial performance. I'll write that down in a second. So that's one thing you have to really understand is these transactions. The second thing is what constitutes business activities. Now, when you read Chapter 2, they use the term business activities a lot. I think not completely accurately. When an accountant uses the term business activity, there are only 3, and they're reflected in the cash flow statement. The 3 activities are running day-to-day operations, and whatever that entails: making goods, selling goods, providing services, what you do to generate revenue on a day-by-day basis. Investing activities, which happens once in a while when you buy equipment or you create a product or technology. And financing activities, which is when you raise capital and when you pay it back. So those are the 3 types of business activities. And we'll get into those in a later module or chapter when we're studying the cash flow statement. You also need to understand financial statement elements. The textbook identifies that there are 5 you're responsible for. Can you name them?
5
financial statement elements.
Financial statement elements.
One is an asset.
Yeah, assets, liabilities, equity, revenue, and expenses.
Right. Now, if you went beyond this course, you probably would identify or be exposed to 2 others, because I identify there's actually 8, but the rest of the world thinks there's 7. The 2 others are gains and losses, which we might get to in this course. I don't know. I haven't got there yet. And in addition, I think that cash flows are a financial statement element because those are the amounts that show up in the cash flow statement. So what else could be in a cash flow statement except the financial statement element of cash flows? So that's how I get 8. The gray ones right now you're not responsible for, but it might help you to understand some of the information if you're aware that these other ones exist. The other thing I think is important in financial statement elements is that we divide equities between what I call owners contributed capital, which is the amount of money that they pay in to capitalize the business, to give it funds to get going. But the second component is retained earnings, which are the profits that the business generates for its entire life that it has yet to distribute back to the owners. And the reason, so all owners' equity belongs to the owners, but it has 2 forms: the amount that they put in and the amount that they're entitled to receive out of earnings, okay? And the reason it's called retained earnings is because they're earnings that are retained. It's pretty simple. It's like the company made a profit. Once it's made that profit, it has a choice of what to do. It can pay it out to the owners as a dividend, or it can keep it. If it's keeping the earnings, it's retaining those earnings. And it could pay out a portion of the earnings. So let's say the earnings for 1 year are $100,000. It might pay out 10 and keep 90. The 10 goes out as a dividend, the 90 is retained. In that case, retained earnings increases by $90,000, okay? The interrelationship among the financial statement elements, I'm going to paint you another picture of this in kind of a big picture context. So it's something that was also required by the faculty for you to understand to pass this course through quizzes and exams. But I'll give you a bit more insight into that. And then lastly, the transaction analysis and processing that you've read about in chapter 2, using the basic accounting equation, the expanded accounting equation, and the flow chart. I just created a way to do it in Excel, which we'll talk about based on your question earlier, because I think it's very efficient. It will increase the proportion of questions that you answer correctly. And developing these skills in Excel is a key business skill that you'll need when you start your career, okay? So let's have a look at, first of all, the financial statements, the elements, and their interrelationships. So from a big picture context, what we want to be able to do with financial statements, if you remember from that first slide, is enable key stakeholders to assess a business's financial position and financial performance. And if you remember, I lined up the 4 financial statements to deal with these particular issues. So the income statement and the statement of cash flows support key stakeholders' evaluation of financial performance, while the balance sheet and its kind of subsidiary statement, the statement of retained earnings, they support the assessment of the financial position. The reason I put a fence around these 3 statements is because the accounting system, through the capturing of data and putting the data in accounts, those accounts are used to create these 3 statements. This one is not created that way. The statement of cash flows is created from these other 3 statements, not from the accounts. And that may be one reason why the cash flows are not commonly included in the list of financial statement elements, okay? All right, so in these main statements, one of the things that you are responsible for is to understand the elements of these statements. So in the statement of income, the key elements are revenues and expenses. In the statement of financial position, the key elements are, sorry, I'll come back to this, liabilities, assets, and equities. All right. Now, in the income statement, revenue minus expenses is how we calculate profit, also called net income. And profits belong to who?
They belong to owners.
Yes, exactly right. So the way we allocate the profit to the owners is by putting it into retained earnings. So what you can see is these two statements are connected because revenues minus expenses gives us profit, also called net income. And net income becomes an addition to the component of owner's equity called retained earnings. Okay. So the retained earnings statement is in what I call a continuity format. It basically, each period starts with the beginning balance. So when you start up a company, it's 0. You increase retained earnings by adding in the profits or net income. And you decrease retained earnings by paying out dividends. Now, you can't pay out dividends if you don't have retained earnings.
Yeah.
It's illegal under corporate law. Okay, so we first of all have to make some profits before the shareholder or the owners can get dividends. And the way the continuity works is you start with the beginning balance, you add something called net income, you subtract something, dividends, and you end up with an ending balance. And that ending balance goes to the balance sheet as one of the two components of owner's equity. Okay, so the income statement is connected to the statement of retained earnings, which is connected to the balance sheet. In addition, when we prepare the statement of cash flows, we do it by analyzing these other statements. And we classify all the cash flows into those 3 business activities I mentioned: operating activities, investing, financing. Running the business and generating cash flow from operations, investing in equipment, raising financing, and paying it back. And so if we add up all the cash flows, positive and negative, for each of those activities, we'll get a net cash flow for the business for a period of time. And this bottom section of the cash flow statement looks very much like the statement of retained earnings, because the net cash flow, which has some pluses and minuses, is what we're adding to a beginning balance of cash to give us an ending balance of cash. And that ending balance of cash goes up to the balance sheet as an asset. So the cash flow statement is also connected to these other statements. Okay. And I just highlighted here in gray that gains and losses, this may be something we look at in the future. You're not responsible for it like in weeks 2 or 3. And so they are another financial statement element. And if we do look at them, they will show up in the income statement. Because gains and losses also increase or decrease the equity of owners. Okay. And then cash flows, I've highlighted all of these in gray as my identification of the 8th financial statement element. But don't worry about that right now. We might get into it like in week 9. All right, let's have a look at these business activities. So what I meant by these business activities, there's basically 3. And they are operating, investing, and financing. And if you see the statement of cash flows, do I actually have a following slide on that? Yes, I do. Okay. I'll show you an example of what they look like in a moment. Now, the difference between business activities and transactions are activities is like a higher level thing. We're operating, we're investing, we're financing. But any activity that has accounting significance and gets recorded in accounts only happens if it's a transaction. Okay. So a transaction is an exchange between 2 parties. And I'm going to modify this on the fly here. Okay, according to, I think it's chapter 3, the transactions also have to be measurable. That means we have to be able to put an amount to it, okay? And they have to be realized, okay? So let's just identify, or recap, the transaction is something that's received or acquired by the business entity as a benefit. Some other thing is given in exchange. It may be a cost to the entity. And one of the things that you need to do as a student of this course is you have to identify the things that are exchanged. What do you receive? What do you give? And one of the ways to think about that is, what was your benefit? What was your cost? It gets accounted for by being measurable and realized. And these are attributes that distinguish a transaction that gets recorded in the accounts from events that may impact the business entity, but they don't get recorded. Therefore, they don't have any accounting significance. Now, here's an example of a cash flow statement. And one of the things that I've taught most of my higher level students is how to break down or deconstruct these financial statements into blocks or classes. In this case, there's 3 classes of activities. And the concept of these blocks, like the first one is operating activities, the second one is investing activities, and the third one is financing activities. All of the financial statements have these blocks in them. And the blocking is just a way of grouping or classifying items of a similar nature. So everything in this first block is all related to cash flow in or out that's related to day-to-day operations. Everything in the second block are the cash consequences of purchasing assets, selling assets, and so on. And everything in the last block, financing activities, reflects the cash consequences of receiving new capital and providing returns to the providers of that capital. Returns could occur in the way of paying back loans, redeeming shares, paying dividends, and that kind of thing. And if you look at some of these things, which you'll be able to do by looking at the video once it's recorded and posted, you'll see that the nature of these items is similar within each block. All right. Also, one of the things that we can establish is in the cash flow statement, we expect the net cash flow from operations to be positive. Because if it's not positive, eventually, the business won't achieve goal number 2, which is survival.
Yeah.
You'll run out of money and then your business will fail. Okay. The expectation is that the net cash flow as a result of investing money into your resources is that this is going to be negative most of the time. Imagine running a restaurant, for example. You have to build the restaurant, and every 7 years, on average, you end up refreshing the restaurant and spending more money, making it cleaner and new paint job or new concept entirely. Okay. And one of the reasons we make investments in equipment is to maintain or sustain the business's service capacity to continue to generate revenues. You can't just buy assets once and run them for 30 years. That doesn't work that way. Even if you imagine yourself being a landlord by buying a piece of real estate, periodically you have to go in and renovate or repaint or recarpet or something like that. Okay. And then the financing activities, the expected sign or the direction of cash flows at the bottom being in or out, it depends on the mode that you're in at the time, whether your business is raising money, for example, to be able to invest in an expansion, or whether the business is in repayment mode, in which case money's flowing out. So the sign on that block just depends on what we're doing. And then at the bottom here, you can see what I was referring to in the first slide, which is in the second diagram, which is the continuity form of cash flow. So if we take these cash flows for each block, this one, and this one, we add them up, these are the net cash flows. If we add those to the beginning balance, we get the ending balance, and these amounts at the bottom agree to the cash balance on the balance sheet. Okay. All right. Lastly, we'll look at transaction analysis and processing. And I'll be brief on this because then we can go directly into your question, which is to deal with the Excel the template that I showed you in class. So I laid out a 7-step approach for my students to be able to follow and increase their confidence, and reliability in actually processing these transactions. So what are the 7 steps? The first thing is you should ask yourself when you're presented with a description of an event or a transaction, what's really going on here? be sure that you understand, like imagine this is your business. You know, how is it impacting your business, right? Remember, if it's a transaction, it'll be recorded. There has to be two sides. It's a transaction between your business entity and another party. That other party could be you. It could be an employee. It could be a customer. It could be an investor. It could be a lender. There's always got to be two parties. And one party is receiving and giving, and the other party is giving and receiving. And they're basically a mirror image. Okay. The second thing is determining whether there's actually a transaction that needs to be recorded. So to record a transaction for your business entity, first of all, it has to involve your business entity and not some other business. That's the separate entity principle. Once we know that, we need to identify the things that are given in exchange. And then we need to meet the criteria that we can measure the amount or the value of that exchange, and it's actually been consummated or realized. If it meets all those criteria, then we're going to record it. And it's going to impact the various accounting equations or have two entries on that Excel worksheet that I showed you in class. All right. Once we know that it's an exchange, we'll identify the elements affected. We might do that immediately, or we might do it secondarily, because if we do it secondarily, we might say, well, I purchased equipment for cash. So I know when this happened, I received equipment. That will be an account. And I gave up an asset, cash, which is also an account. And then in chapter 3, you're going to be required to be able to associate accounts with financial statement elements, which simply means what kind of element is equipment? Okay, it's an asset. What kind of element is cash? It's also an asset. Now, once we know that they're assets, we can then go and use the Excel template to figure out how do we end up with the general overall impact on assets, liabilities, equity, and the other elements, okay? So if we've identified the elements affected, we assign amounts because we've identified if it's a transaction that's measurable. So the amount is the magnitude. And then we have to assign a direction, a plus or a minus, positive or negative, as it affects the element. In other words, are assets increasing? Are revenues increasing? If that's the case, we enter positive numbers. If the impact on the element is decreasing, we enter it as a negative. It's that simple, okay? Then once we know this information, we can enter it into some learning aid, like the accounting equation where you're doing manual calculations, or you can do it on Excel. But if we're going to do it on Excel, then the next thing I want to suggest is if you get really good at Excel by always including a check on the work that you're doing. And as I demonstrated in class, what I like to do is I have a check on every single line, and then I have a check on the totals at the bottom. And if my checks always work out to be zero, the reason I designed the equations to give me a zero answer is it's so easy to see if it's not zero, right? So if anything shows up that's not zero, I can immediately pinpoint that I've made a mistake and where it is, and I can fix it quickly. But if I've processed all these transactions and I've got checks that are 0, 0, 0, 0, 0, I'm pretty confident that I've done everything correctly and I've got, for the most part, the right answer, the answer that we're seeking. So I check every entry to be sure that it's balanced. And if every entry is balanced, the grand total should also be balanced. And that's what we mean by keeping the basic accounting equation or the expanded equation in balance, okay? And so this is an example of what I showed you in class, as a simple analysis of a simple example of transaction analysis. Let's just back up for a minute. So transaction analysis is basically steps 1 to 4. Transaction processing is steps 5 to 7, okay? And what you can see in this worksheet is our input data is basically a list of events or transactions and a list of amounts. And in this part of the worksheet, we're allocating the amounts to the different financial statement elements. And because we're using, because a transaction involves an exchange, there's two parts. We use what's called the double entry system. So for each line, there has to be two occurrences of the allocation of that amount. And over here, you can see I've got these checks for every single line. They're all zero, and the grand total is zero as well. The other thing you'll note about the way I formatted this, it's also in that continuity form I described for the statement of retained earnings. It starts with beginning balances for the period. It lists all the transactions that occurred during the period. I total those up, I add them to the beginning balances, and I get the ending balances. Okay, so that's the continuity. Next period, I'll start with beginning balances that were this period's ending balances, except revenue and expense will always be zero to start with, because we measure revenue and expense only for the period. Okay, and then I'll get new balances at the end of the second period. So based on all of that, do you have any questions about the concepts I discussed? Or do you want to go right into your question on the Excel template?
Well, I think one of my questions segues pretty nicely from what you were talking about in keeping things balanced. In class, we talked a lot about services. We talked about the lawn mowing business, the dog walking one. So I was interested in product and how that works, because especially when like you buy a product, you're usually like selling it back at a markup, right? So I was wondering about how the accounting works in that.
That's an
like,
excellent question.
yeah.
All right. So why don't I exit this presentation, and I will let's see if I've got. Okay, I'm going to bring in my Excel worksheet where I've set up this template. Can you see it?
Yes, I can.
Okay, I'll just make it a bit bigger so it's easier for you to read. This is actually what I'm working on for next week. So let's go to take a blank one here. Okay. Actually, I want this one. Yeah, I put this in the wrong place. Give me 1 second. Create a. Let's move it to S325. Okay. Now I want to create a copy of it. Okay, so what we'll do is we'll create something using your question. So let's just clear this information out of here for the moment. And let's see how we would build this up for a product company that we just started up. So let's use, excuse me 1 sec. Let's use the idea of a pop-up business where you're going to import some blue jeans, or you're going to buy blue jeans from a supplier. You're going to throw them in your vehicle. You're going to drive to Yonge and Dundas Square. You're going to park your vehicle somewhere, and you're going to come out with a box of these blue jeans, and you're going to stand in Yonge Dundas Square selling these blue jeans out of a box. All right. So what we're going to do, first of all, in order to make this business work, we're going to purchase let's say 20 pair of blue jeans. At let's say $40 a pair. Okay, how much is that? How much is that going to cost you?
80.
Try again.
What? $40 each for 20. 800.
Okay, 800 it is, right. Now, the question is, first of all, how are you going to pay for this? So let's keep it simple for the moment. And let's pay for this stuff in cash, okay? So if you remember, step one of the approach that I was suggesting is you have to, first of all, think to yourself, what's really going on here? And then describe in your own words the components of this transaction. See if you can identify what's happening in your business. See if you can describe this for me. And as we're talking, we'll identify what amounts affect assets and what amounts affect liabilities and so on. Okay.
Mm-hmm.
Over to you. Don't worry about
cool.
what I'm doing. I'm just preparing to be able to enter this information.
Cool. Yeah, what's happening is that we are spending an asset, which is cash, in order to buy a new asset, which would be the jeans, since the jeans will let us,
Sure. Excellent,
make more
excellent. So what are the impact on these accounts?
That would be a reduction in assets, but also a raise in assets.
So which asset is reduced?
The asset of cash.
All right, so we'll put a reduction of assets representing the payment of cash, which is equal to the negative of this amount. Do you agree?
Yes.
Okay. And now I'm going to try to reformat these so they come in a format that I like. Okay. So cash is down $800, and another asset you said has increased by 800. What would you call that asset?
Inventory?
Yeah, that would be inventory of blue jeans. Okay. So let's just make some notes out here. So this is inventory of blue jeans. And we'll call this column the accounts. Now let's make this a little bit larger so perhaps it's easy for everybody to see. And this is cash. Why is this not working? There we go. All right. Now, the next thing is we take this box of 20 blue jeans and we go to Young and Dundas Square and we start selling these blue jeans. So just to make things easy, or to make things slightly more complicated, let's suppose you go there, on Friday, and you start selling these blue jeans at 11 a.m. You've only got 1 hour before the class starts, so you do the best you can in that hour, right? And let's say that we sell 10 pairs of blue jeans at $90 each. Now, explain to me what's really going on here, and also what accounts might be affected.
Mm-hmm.
So as you do this, think about what you're receiving and what you're giving up.
Mm-hmm. So first we're giving up 20 pairs of blue jeans.
Just 10 at the moment. Just 10 at the moment.
Sorry. Yeah, we're giving up 10 pairs of blue jeans. But we're receiving $90 each for them.
I don't know why I'm having difficulties with this. Come on. This is weird. Okay. So the first thing you said is we are giving up we are reducing inventory.
Yep.
Okay. Inventory. So the inventory account is affected. The reduction means we're going to reduce an asset, and the asset is going to be inventory. So we need an amount for this, first of all. How do we compute the amount?
I guess we reference back to the original price of them that we bought them at, right?
Right. So in this one, we actually, what I should have done here is I could have put this as a formula. I asked you to calculate it in your head, but there was really no need, because in Excel, I could just take 20 pairs of jeans, multiply it by $40, my cost. That's how I get 800 bucks. Okay.
Yep.
Now, if we're going to sell 10, then the amount of the transaction is going to be 10 pairs of blue jeans times the $40 cost per pair, right?
Mm-hmm.
And we know that we're reducing the inventory. So the impact on the assets has to be minus $400. My inventory of blue jeans is now reduced.
Yep.
Sorry, we forgot to put in the $800 up here. There. And I have something out of balance because this formula needs to include rows 10 and 11 there. Yes. D10. Well, I've got an error in my formula, so let's see if I can fix this, or we can fix it together.
Cool.
In order to balance this equation, I need all transactions in assets on the left side of the equation to equal all transactions on the right side of the equation. But if I do that, I'm going to end up with a logic result that says true or false. And that's going to be a little bit more complicated for me to run down the list and see if everything's in balance, okay?
Yeah.
So what I like to do with my checks is I like to design an equation that should be zero if everything balances. And we actually had one question like this in chapter 1, which was the different ways you could reorganize the algebra of the basic equation so that it was true.
Mm-hmm.
And so what I like to do here is I basically want to take everything on the right side and move it to the left side as minuses, so that if the assets minus everything else equals 0, then the equation works.
Yep.
So the way that needs to work here is I want to take the sum of anything in my asset category, and I want to subtract the sum of everything in all these other cells. Okay.
Yep.
And you can see now we've got 0. So I'm happy with that. I want to basically copy this formula, copy this formula down to here, but I'm going to do a little quick adjustment and eta I12 to, I'm just going to go to 15 because I know what to expect here. All right, so right now we're out of balance because we've entered in one part of your transaction, which is what the business gave up.
Mm-hmm.
It gave up its inventory. But what did it get in return for giving up this inventory?
In return, it got $900 worth of cash.
Okay,
yeah.
so we're also going to affect cash. And the way we compute the cash amount, which is an asset, obviously, is it's not equal to the $400, right?
Yeah.
This $400 was us giving up the cost. So what we actually have here is we have 10 pairs of jeans at a selling price, not our cost. The selling price was 90, and that's where you get the 900 from. And so the impact on cash is when we sell the jeans, we receive from the customer $900 in cash, right?
Yep.
Now, this formula up here should be the sum of D12 to D15.
Oh, we didn't put anything in.
To I15 there. Okay. So right now, I'm actually looking at 4 lines here.
Mm-hmm.
I've got these 4 lines in my equation because I anticipate what's going to happen. But what you can see right away is we're out of balance because we're accounting for one part of the transaction at our cost amount, and the other part of the transaction we're accounting for at a selling price. As it turns out, if you think about what's really going on here, you sold jeans for $900. Those 10 jeans cost you $400. So you actually made a $500 profit.
Yeah.
And that's what this $500 is. But we haven't appropriately reflected the transaction in the accounts, because if we had, this $500 check balance should be 0. So this tells us that we're missing some other parts of the transaction to balance the equation. And if you look at, this analysis, and if you look at some of the, previous analysis that we've looked at, like this one, every transaction, we've got 2 elements in the same amount, right?
Yeah.
But we haven't done that in the sample that we're building here. We only have one transaction part for 400. We have one transaction for 900. So each of those is missing a part.
Yeah.
The balancing part. All right. So here, let's deal with, first of all, this is the sales part of the transaction. Perhaps the more easy one to understand.
I see.
So go back to, what did you get? What did you give? Okay.
Yeah.
And now we actually, on this one, we can go to some of the enhanced questions and ask yourself, was there any earning going on?
Yeah. Definitely that's revenue.
Right. So what we should, and is revenue increasing or decreasing?
It would be increasing.
Right. So if we put the revenue at $900, we've now got a balance on this line, but these 4 lines are actually part of one transaction, or we can make them 2 separate transactions. That's fine. Let's actually do it that way, in which case I'm going to copy this formula into here and into here. Okay. Now you can see that this one that deals with the selling part of the transaction, it's balanced. We received cash and we generated revenue. Now the question is, you've allocated this to revenue, but how do you know? How can you justify that it actually is revenue? In other words, it has to meet some definitional criteria of revenue. So how are you confident this is revenue?
Because we've done we've given the business has done like a service for someone or given something to someone.
Exactly.
Yeah.
So the key criterion here is the business has performed something, and the act of performance justifies the recognition of that performance as revenue if you can measure it.
Yeah.
So what did we perform? Well, we delivered goods into the hands of customers. When you are a product company, the key measure of performance is delivering goods. When you're a service company, the key measure of performance is rendering the service, like painting, building a deck, doing somebody's accounting for a fee, okay? Fixing somebody's plumbing. All right, so we've accounted for the revenue side of the transaction, but you've also accounted for half of the cost side of the transaction. So what we've acknowledged in this first transaction is that when we sold 10 pairs of blue jeans, the asset inventory is declining.
Which means we just consumed.
Exactly.
Yeah.
Or use those jeans by selling them.
Mhm.
So if you consume or use something, what is that? What kind
That's
of
an
financial
expense.
statement element?
An expense.
An expense.
Yeah.
So what we need to do here is allocate to expense the cost amount of these blue jeans. Why do I have, so the sum of these minus the sum of, okay. So I have to perfect this equation because it's really subtracting the sum of E to H and adding the sum of H12 to H13 because of the negative impact expenses have on equity, right? So an increase in expense decreases equity. And obviously I don't have this working out well. So why is that? The sum of D12 to D13 is the impact on assets. And the sum of E12 to E12 to, oh, I see, I've got a double counting here. This should be E12 to G13. Add back the sum of H12 to H13. Let's try it this way. Oh, it's not working. 13. Let's get rid of 13. So let's just deal with whatever we have as the impact on assets is in D12, and that has to equal the impact from cell E12. Let's say the sum of E12 to E13 to G12 minus H12. So the way I'm trying to make this formula work, let's see if this works finally. I'm trying to recognize any impact on liabilities, revenues, or equity, less the impact of expenses, equals C12, equals minus C12. Well, you'd think as an accountant, I could figure this one out.
Have you inputted I at all?
Oh, that's what's missing. I'm using H instead of I. Yeah, good work. So this should be E to H, and this one should be I. Good catch. There we go. So now we're in balance.
Nice.
So the answer to your question, which is what happens when we're selling goods and services, is you need to recognize that that transaction really has two parts.
Mm-hmm.
It has the using up of the inventory and the transfer of that inventory to an expense that we label. Let's put that label on there. Inventory. The other label in the expenses is cost of goods sold. That expense has to be on the income statement, okay? And then on the revenue side of this, we are affecting cash or some asset like accounts receivable if we're not paid in cash, and revenue, okay? We'll call it sales revenue as opposed to service revenue. So those are the accounts affected. Now, if we zip down to the bottom here, what you can see is the net effect on assets. We exchanged cash for inventory, then we dumped some of the inventory. So we're down to $400 of inventory. and we have $900 of cash. So that's a net change in assets of $500. And how did that happen? We sold goods for $900 that cost us $400. So if we look at the profit, we made $500 profit, which increases our equity. So in the basic accounting equation, the changes are assets went up $500, equity went up $500. We can account for the equity as the difference between the revenues and expenses, or the revenues and the cost of the jeans, for 10 pairs of jeans. We're selling them, and a way to double check this, using a different approach, is to do it on a unit basis. Each pair of jeans we sell for 90, they cost us 40, we make 50. We sold 10 pair, that's a profit of $500. Since it's a profit, it increases the equity of the business as retained earnings if we're not paying it out to you, the owner, right away. So that's how we made $500 of profit, which increases our equity.
Yep.
Now, that's part of the financial position. Where is the other balancing part of the financial position? And what we can see there is we spent $800 buying these jeans. We sold half of them. So this 800 and this 400 both affect the inventory.
Yep.
We had 800, we sold half of them, we got $400 left in inventory. And we have our cash balance, we spent $800 buying the whole inventory, and then we sold half for $900. So when we bought the inventory, our cash went down 800, and then when we sold half of them, our cash went up 900. So that increased the cash balance $100. And if we add that 100 to the net increase in inventory of 400, that's how our assets increased by 500. Okay. So the quick answer to your question, what happens in a product company? You have to account for a sale of a product with two parts of the transaction, the selling part and the transfer of cost to expense. Okay. All right, so hopefully that also gives you some insight into the use of this Excel template. It's after 8 o'clock now. If you've got one more question related to the use of the Excel template, I'm happy to answer one more question.
Oh no, my next question was like, because I had like certain transactions using up like those two rows, so I couldn't like get the formula down, but like since we like solved it and all that stuff, like I know now. So
excellent. Okay. All right, well, thank you for coming and thanks for your participation.
Of course.
And I'll see you in class on Friday.
You too. Hi, thank you so much.
Take care.